Alternative asset manager Ares, out with earnings yesterday, now has $546 billion in assets under management. Executives told analysts on the earnings call they're optimistic about its portfolio, given, quote, limited exposure to tariff rate changes. Joining me now is Michael Arougheti. He's the CEO of Ares. Good to see you.
Great to see you, too.
And nice to have you coming off earnings. All right, almost $550 billion in assets.
Hard
Obviously,
to believe.
you and I have talked for years. I can remember when it was a far smaller number.
Yeah.
Does that in any way mitigate your ability to continue to generate what I would argue have been somewhat outsized returns? One of the key reasons for your success, because you're a big boy now. You're not playing in a small pond.
It's so fascinating because every time you grow at the rate that we've been growing, 20 to 25% per year for a really long time, you ask yourself, where's the outer bound? I think what we've learned in alternatives, and particularly in private credit, size actually enhances performance. And the reason is we just are able to put more people in more offices around the world with more products. So we have more relevance to a bigger client base and a bigger investor base. So in some respects, growing off of the $500 billion plus AUM base is easier than growing when we were $50 billion.
You can just, source more opportunities?
Exactly. Yeah, I think we have more competitive advantages, more scale, deeper relationship networks, broader distribution. And then you get this network effect that gets created when you have these portfolios at scale. Right. So one of the things people don't fully appreciate when you look at our credit business, half of our deployment is into the existing portfolio.
Yeah.
So you just create these big compounding portfolios.
And you don't think you need to kind of climb the risk ladder to a certain extent to generate similar returns?
I don't think so. I mean, alternatives have expanded over the last 20, 30 years from what used to be very high absolute return product relative to the liquid markets. Today, alternatives span 3% high grade all the way down to private equity and all things in between. So you don't necessarily need to reach for risk to grow. In some respects, growing the lower risk, lower return things is probably the easiest to do.
Yeah. You added, I think, $20 billion in assets during the
Yeah, we added $20 billion.
quarter.
Coming off of a record last year, we raised $93 billion.
Can you continue at that rate?
Yeah, I think we can. We told the market to expect that we would come at or near what we did last year. We have about 35 funds in the market around the globe. The product set is diversified. We're deep in the institutional channel. We're deep in the wealth and retail channel, deep in insurance. So the broadening out of the product set and the broadening out of the distribution is making those numbers pretty consistent at this point.
The next opportunity seems to be at least trying to really gather up retail to a certain extent. Yesterday I spoke with Mark Rowan from Apollo. They launched that ETF.
Yep.
Blackstone seen potentially doing something similar. BlackRock probably not far. Is that something you think about? And how do you address this question of providing daily liquidity for what is underlying an illiquid asset?
There's a lot to unpack, so I'll try to keep it brief.
Sorry,
First of all,
it's a long question.
Ares is very, very significant in the wealth channel. So we have about 170 people around the globe with 10 products that are giving people diversified access to what we think is the best of Ares. Durable income product, differentiated equity, tax-advantaged infrastructure. We did about $5 billion of asset origination in the wealth channel this quarter alone. I think
that's not a daily liquid product.
No, they tend to be monthly or quarterly. So we are huge believers in broadening access to alternatives for the retail and high net worth investor. It should not just be the purview of the institutional investor. I think what makes them so valuable is, in some respects, the lower liquidity, right? I mean, part of what has happened in the retail products that were available in the past, BDCs, mortgage REITs, yield cos, MLPs, the retail investor has tended to buy procyclically and sell when the market is probably most attractive. So in some respects, locking up that capital is able to protect the investor from themselves and drive higher return.
Yes.
I personally am not sold on the idea of making illiquid products liquid.
Why not?
I think there's already a diversity of product in the market. So if you take ARCC, which is our traded BDC, $30 billion portfolio, 20-year track record, daily liquidity, trades on NAV. So that technology exists. It's proven. There's no need for market making. There's no, hand-wringing over the valuation of those assets. And so there's a lot of energy going around trying to innovate how to make illiquid assets liquid, and I feel like that technology already exists.
Interesting. You know, when you mention NAV, it makes me think of Marx. And what I'll hear from some of your competitors in the commercial banking arena is, hey, when we do a financing for a similar company or bridge financing, we're marking it at a different level than they are in private credit, and they're getting away with it. How do you respond to that?
I'm not sure that that's true. I mean, the valuation methodologies across the private markets are pretty tested, tried and true. It is frustrating for people who spend their lives in the public markets with daily marks. I think they're trained to believe that that's the intrinsic value of an asset. I think most private market practitioners will say they care about the price of an asset twice in its lifetime, the day they buy it and the day they sell it. And all of the vagaries and ups and downs in between, you know, we have the luxury of not having to to worry about that, but I don't think that that's a fair comment.
And how should I view things? Split coupons, I'm being told now, where it's, you know, it's cash pay some, but there's also a pay in kind portion of it, which would seem to indicate the underlying credit is more risky over time, given they seem to be accreting in terms of interest payments. How should we view that?
I think it's the opposite. I think the equity is more risky because when you're using PIK, particularly in a moment like this, it's typically because rates are high and a disproportionate share of a company's free cash flow is going to service debt rather than growth. So the equity owner is willing to pay a little bit more in rate to get some flexibility to reinvest in growth and drive equity value.
Right.
So if you think about the PIK, it's actually happening on top of the equity, senior in the capital structure. So as it's accreting, it's actually to the detriment of the equity and the benefit of the credit.
Understood.
Not the other way around.
Understood. Yeah. So do you expect that will continue in this rate environment?
I think if rates persist at this level, you'll continue to see it, particularly given that we haven't necessarily seen valuations in the private market come down as much as you would expect, given what's going on in the world. But once you see valuations contract and rates come down, you'll see a lot less of that.
You'll see a lot more just cash pay.
Yeah.
Yeah. I want to move on to something that you mentioned in the call. It's a different area, of course. It's the secondaries market and LP interest in private equity, where you're making a more concerted effort, I guess. Is that fair to say?
Yeah, so we acquired a firm called Landmark about 5.5 years ago, pioneer in the secondary space. And we bought it with a view that secondaries was going to go through this moment of transformational change and growth with a shift from LP-led secondaries to GP-led and an expansion from just private equity to credit and real assets. And all of that has happened. What we didn't fully anticipate was how gummed up the private equity world would be in terms of lack of monetization.
They can't get exits, whether it's IPOs or sales. Right.
So secondaries is front and center now as a creative liquidity solution provider, and we're seeing that in the institutional market. We're seeing it in the endowment community. We're seeing it in the GP community, where GPs, in order to get to their next fund, need to get some monetization themselves.
I did want to come to you on endowments because I think that's somewhat unexpected. And I mean, you even spoke about it in the call, you know, in terms of significant reductions in research funding, anxiety around their tax status potentially. Yeah. Are the endowments actually looking to sell some of their private equity interests?
Yeah, we're absolutely seeing that. And again, I think we're trying to be a collaborative, creative partner. I think the good news for the more established research universities, they have large endowments with, you know, attractive assets. They also have other attractive assets, intellectual property, patent portfolios, real estate. So we're trying to approach those relationships, and we have decade-long relationships with them as a creative solution provider, not just going in as a secondaries buyer. But yeah, I think given the state of the world for them, they absolutely have to be looking at any and all things.
Kind of unexpected, though, isn't it? I
yeah.
mean, I wouldn't
don't think any
we would have been
president,
sitting here talking about this as
right.
a real threat to them.
Yeah, I think that's right.
Are you hearing from more than the universities that are currently being targeted? I'm just curious.
I think most are planning if they're not being targeted, because like any company or any investor right now, you have to start scenario playing. There's a lot of uncertainty in the world. You don't know which way it's going to break. And particularly if research is permanently, you know, off the table and your endowment is challenged, you're going to have to look for liquidity somewhere else.
Speaking of, we don't know how things are going to break. Let me end on the macroeconomy. I'm just curious as to whether you have a view right now and what it is.
Yeah, my hope is that this will resolve itself shortly. I think that we're getting good messaging out of the administration that we should expect, you know, some positive news here in the next week or two. My own view is the most beautiful word in the English language isn't tariff, it's certainty. And I think the minute that the market gets some kernel of clarity that we'll get back to a normalized base. The challenge that we're all having as investors is when we look through to our portfolios, performance is still incredibly strong.
Yep.
So the economy today still on excellent footing, consumers resilient, the fundamentals are there. So I think it's really just a question of time. If we move quickly to a higher level of certainty, I think we can push through this. If it goes on, significantly longer, then obviously it'll have.
And
more
what are you hearing from your
consequences.
portfolio companies? Same?
Same. I think everyone's kind of taking a breath. Deal activity's slowed down. CapEx has slowed down. Hiring has slowed down. There's no benefit to making any kind of a major strategic decision right now. But it's been a couple of weeks, and I think the markets can handle that type of a pause. So again, if we start to see some momentum on the trade front, I think that this could all clear up.
All right. Michael, always appreciate it.
Great to see you. Thank you.
Michael Arougheti, the CEO of Ares.